This is Jack Amy at Moneyfarm with an update on our outlook on global markets and some of the changes we've made to our portfolios. Over the last few months, we've seen plenty of growth in the global economy. 2021 has, for the most part, lived up to its billing as a year of recovery, and this is something that we feel will continue, albeit to a lesser extent, over the coming months. A key factor for us in this rebalance is the noises coming from central banks. After a sustained period of hyper-accommodative monetary policy, the major central banks like the Fed and the ECB are beginning to chart a course back to normalising interest rates. Inflation continues to be an important consideration, and this may be part of the thinking from central banks. You also have ongoing supply chain issues, most notably in the UK, with fuel the most obvious example as petrol stations across the country run short on supply. These issues may cause price increases on top of the obvious disruption that they're already having. For our lower risk portfolios, the key has been the rhetoric coming from central banks. Given that these portfolios are more weighted towards bonds, any normalisation from central banks will have an impact. Specifically, an increase to the long-term levels of interest rates would negatively affect bonds prices, albeit to varying extents. Since bonds with longer maturity are those affected most by rising interest rates, we have reduced our position in government bonds and US corporate credit. We have primarily replaced them with high-yield corporate bonds, which should benefit from having a shorter duration and from continued economic recovery. We also switched some of our emerging market bond exposure out of local currency, simply as the increase in yield against the dollar-denominated equivalent wasn't enough to offset the greater currency risk. But this is a reasonably minor change. These changes affect all but our highest risk portfolio. Though the lower the risk of your portfolio, the more it will have allocated to fixed income. For our higher risk portfolios, the chief concern is equities. Ultimately, we have assessed where we are on our equity exposure, and we've decided to broadly maintain our current position, save for a couple of small changes. We expect growth in the coming months to be more muted than we've seen so far this year. However, with bond yields still low and economic growth likely to be modest, equities still seem the best place to be. The key change here is we have closed out our fairly small position in the FTSE 250. This has performed well since we added it to our portfolios, but we are slightly more cautious about the outlook for British mid-caps in light of the recent supply chain issues and the knock-on effects that may feed into the economy. We've broadly redistributed this money with a more global approach. Another thing we assessed was whether we would close out our value position. Our expectations for it to outperform have been lessened since we added it to the portfolio, but the recent narrative from central banks around a return to normal rates has encouraged us to hold on. It's still a fairly modest position relative to the rest of the equity portfolio, and there has, traditionally, been a correlation between bond yields and the value factor. Specifically, the value equity provides a bit of protection against any increase in rates. We've also had to consider our emerging market exposure, which does have a tilt towards China. Our exposure to Chinese markets is small and only applies to our higher risk portfolios, but this was still an important part of our discussion for our investment committee. On the one hand, reducing our exposure to an area that's been struggling for some time seems sensible. On the other, some of the world's highest performing and fastest growing businesses have been quashed and could represent a real opportunity. The outcome here was that while we think there could be an opportunity there, we are reluctant to add more to an area that's already seeing plenty of risk. As a result, we decided to maintain our modest position in that area. All in all, we've changed our allocation at the margins with an eye on what we expect to happen over the coming months. These changes will, in our view, make our portfolio better suited for navigating the normalisation of monetary policy and of the wider economy, a process that we expect to pick up pace in 2022 and onward. We encourage you to reach out to your investment consultant if you have any questions.